Welcome to today's Technically Speaking Tuesday. I'm your host, Lance Roberts from Clarity Financial, and we're talking about this market. I tell you what, it's been a wild ride here over the last several weeks. Just when you think it's getting over, right? It's a new wrinkle in it. Interestingly enough, the market bottomed back in November. We had this nice bounce into early November, sold off again, Thanksgiving, rallied back after Thanksgiving here on the back of really Jerome Powell right here at the bottom saying that, well, we may slow down the rate of rate hikes. And then, of course, the trade announcement over the weekend with Donald Trump, of course, that jacked the markets up. And we were very excited yesterday because the markets actually got above the 200 and the 50-day moving average. That was bullish. And as I wrote in today's Technically Speaking post, is that only matters if the markets can maintain that over the course of the week. Well, today, the markets come to the realization that the trade truce really isn't much of a trade truce because China isn't saying anything about a truce on trade. And as I discussed yesterday on the show, that China is not going to give up the technology rights. This is the thing that they want. Their ability to harvest technology and technological information is the future of their economy. And they're not going to agree to any trade deal that restricts their ability to acquire technology through trade. Now, having said that, today the market's starting to come to that realization as well. Market sliding back below the 50 and the 200-day moving average. And this now puts a triple top into place for the markets. And this is important because now we've got a lot of resistance set up here at 2,800. This has now become a key critical resistance point. And if the markets break the lows from October, November, that's going to be a much bigger impact to the market. That could spell another 300 points of downside for this market. So again, being a little bit more risk averse here is something important. Now here's the other thing here, that outside of this just being a sell-off, we've talked about over the course of the last several weeks that bonds, despite the fact that we've had a lot of volatility in the market, bonds have really not moved a whole lot. Bonds were trading between 3.2, 3.3%, kind of drifting down here a little bit. And I've noticed here over the last couple of weeks, we talked about how this bottoming process had come into bonds. And we were starting to see a rotation into safety from investors putting money to safety over this. Well, of course, after Jerome Powell's statement, the realization is that the Fed slowing interest rates suggest that economic growth and inflationary pressures are actually much weaker than what was currently expected just in October, right? This is a big change just from October. And what you see here today, a very, very big jump in interest rates. The interest rates have now dropped below 3%, and more importantly, the yield spread between the 2 and the 10. Now, this is the inverted yield curve. Now, I've got a piece coming out on this on Thursday, but what the inversion looks like now is we're just 0.11 points away from actually having a negative inversion on the yield curve. Now, a lot of people are saying, just ignore the yield curve. Yes, it's always predicted a recession in the past, but this time is different. I wouldn't really argue too much with history because what the yield curve is telling you is that the demand for credit on the short end and the long end is changing. And that is really a sign of what's happening with the economy overall. Lower pressures of inflation, weaker economic growth, and potentially this is why when interest rates shift, this is what causes economic contraction. Look, the reason the Fed raises interest rates is to slow economic growth. That's exactly what you see going on in the economy right now. Now, one more thing here, continue to take a look at what's happening with small caps. They're very economically sensitive, rallied right back to the 50-day moving average, well below the 200-day moving average, failed there, turned lower. They are threatening a break of those October, November bottoms. Take a look at mid caps as well. Exact same story here, a rally, a failure, turning back lower. And again, small caps, mid caps are vastly underperforming large cap stocks. And again, now you move back to the large cap indexes, you're seeing that same type of weakness here, declining trends in place, the 50-day about to cross below the 200-day. All this to suggest is a lot of downward pressure on stock prices currently. So that's why we're still holding a good bit of cash right now, still maintaining kind of an underweight position relative to the markets until we get a little bit better clearance here. And of course, recently we've been adding bonds and shortening up durations and improving credit quality. So our bond side of our portfolio continues to do very well here. If you have any questions, get by the website or send us an email directly at realinvestmentadvice.com. I'm your host, Lance Roberts. Thanks for tuning in today, and we'll see you next Tuesday for Technically Speaking Tuesday right here at realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.